Hello and welcome to Fireside with a VC. My name is Andrew Romans, and I'm very happy to have my old friend Jack Young with us. Jack has been in venture for the magical, I think, Jack, is it 12 years now? Is that right?
That's correct, yes.
12 years to me is a magical number because it means, the normal cycle is 10 years with the ability to extend to, and I think Mao Zedong said, seek truth through facts. A lot of facts that you experience, really drive your understanding. So Jack is a partner and the head of the venture team at DTCP, which is Deutsche Telekom Capital Partners. And Jack can explain to us what that is. But before we jump into things, today is May 20th, 2020. We are hopefully nearing the end of, we're in month 3 of a lockdown for Jack and I live in Silicon Valley. So we're enjoying working from home, but I got dressed up for Jack today, normally one of the best dressed men in Silicon Valley, to feel a little normal. But Jack, I want to talk about corporate venture capital. I want to talk about valuations in the late stage private market and how that compares to the public market. And I also want to dive into some corporate venture capital CVC questions. I know you have a lot of experience at Qualcomm Ventures and understand the interplay with Deutsche Telekom, but why don't you introduce yourself and tell us what DTCP is?
Yeah, hi. So I'm Jack Young. As Andrew said, I've been a venture capitalist for more than a decade. So that means I've been through a couple of crises, right? So DTCP, it started from Deutsche Telekom in 2015. When we started DTCP before 2000, Deutsche Telekom, I should say, before 2017, have a long heritage of a CVC practice. Used to be under the name called T Ventures. So they invested a number of very high-profile companies. But in 2015, Deutsche Telekom decided to take a step forward, right? So CVC has certain limitations, especially in terms of how the decisions are made. So basically, the formation of DTCP started in 2015. I joined the firm in 2016 in charge of venture capital. DTCP now, after 5 years, close to 5 years of operation, we have now grown to close to 40 investment and management professionals around the world. Last year, we just opened up a 4th location in Seoul, Korea, in addition to the first 3 offices we had in Silicon Valley, in Israel, as well in Hamburg, Germany. So today, we are managing roughly about a $1.7 billion assets under management at the advisories and span across 3 different assets. In fact, we have venture capital and private equity, as well as advisory services, as my shirt says.
Right. So under DTCP, if you can't read it, it's VCP and advisory. And Jack, what does that mean? I mean, venture capital I think of as minority investment positions, but clarify stage for DTCP. And then PE to me means taking 51% or more and a controlling stake. And then there's advisory. Define those 3 for us.
Well, it's interesting. So let me take you back a little bit, right? So my background. I've been working with Qualcomm Ventures and later was at DRX Capital, which is a joint venture capital firm by Novartis and Qualcomm. So my first good 7-8 years has been spent a lot with CVC. So working with CVC is interesting, right? Because you're somewhere in the middle, because one side you have to deal with the strategic intent of a corporate, the other side you have the financial return expectations versus a pure financial VC. They have lots of freedom. So as a CVC, you have to dance between the 2. So what happened is at DTCP, we also have to balance the 2 because our largest corporate sponsor is Deutsche Telekom. Now, obviously, we have evolved. So let me just take you back in 2016, when we started, it was basically set up as a single GP LP fund, right? So
and Jack, was that a 2 and 20 structure? So off the balance sheet, 2 and 20 structure?
That's right. That's what we try to. One of the limitations we find out in the CVC is obviously how do you align the risk taking as well as a rewarding, right? So the case in point, when I was in Qualcomm, we had a numerous huge hit, right? So Fitbit was one of those, and later on we had a Zoom, etc. While you take a great pride to be a good investor in a CVC setting, but I'm sure behind the door everybody goes, well, how do I be financially aligned? It will be a nice reward as well, in addition to the pride. but nevertheless, for those working the CVC, we understand what we're getting into. We take a pride for our success. And certainly, you know, when Fitbit and Zoom and all the company went public at Qualcomm back in my old shops, people are extremely happy and they wear lots of confidence. Yeah.
So with what stage is TTC? Well, is T Venture still operating? It is, right?
No. So what happened is when we started DTCP, we inherited a T Venture portfolio, right? So let me just take you forward. So back in when we started in VC back in 2015, so the first commitment is a single LP, right? So DT basically committed 150 million euros to our fund one. So what we did is that back in 2016. As you know, my background, I've been a healthcare investor actually before joining DTCP for 6 years. I thought that was the rest of my career is going to be focused on digital health. But when I got a call from the DTCP and they told me they already have a fund as a structure set up and invited me to be the head, I thought it was intriguing. And I also realized I looked at my first 8 years. You talk about 12-year cycle. The first 8 years, I looked at all the things that I did, the things I liked and I didn't like. So since somebody offered me a clean sheet, I said,
"Oh,
maybe
gosh,
this is what we're gonna do, right?" So which is interesting. Well, so led me to the point in 2016, we took a big bet, which is mostly career-wise, and I'm very happy that my partner actually support me for that. So having said, I spent 6 years in digital health, so I'm a little bit rusty on the technology side. But one thing I realized back in 2016 is the tailwind are so strong. Today is obviously almost laughable when I say that, but back in 2016, I realized digital transformation is coming a big way, especially cloud-based software. So at DTCP, when I took the job in 2016, I basically says, let's 100% focus the capital we have got entrusted from DT to focus on digital transformation. So what does that mean? We're basing on bet on 3 trends. Number one trend is today is like it's almost like given, right? So it's quickly moving to cloud computing, right? Online on-premise software quickly moving to cloud. That's number one premises. Number two is perpetual license is going to transform more favor into subscription business. As you know, still back then it was still a new concept. People buying perpetual license and you have to get them to pay monthly or yearly, you know, subscription, right? So number two. Number three, the bet is we're betting the days of that, you know, a turnkey, monolithic, tailor-made software, one giant software like from big traditional company. Those days are over. That's could become one second.
That's okay. It sounds like the bat phone is ringing near there.
Actually, no, it's run out of batteries. So sorry, I just
okay.
About that. We have to edit this part out. So
we're talking about digital transformation, focus on SaaS, maybe digitization, or where were you on investment themes?
So on the last piece is that we believe that the days that, you know, customized software just for your corporation, those days are over, and then people from a monolithic to a point solutions, right? Today we're so happy to use Zoom for this, we use Expensify for this and that, and so if you look at average corporations, you probably have thousands and thousands of applications that you use on a daily basis. So those are the 3 bets we made, right? And happen to be, you know, if you fast forward in 4 years in the venture journey that we're taking, pretty much right on, right? All 3 bets. And especially today's environment that, if anything, that accelerate the digital transformation. So let's just take you the journey a little bit. So basically when we started, you know, a clean start DTCP venture side, we had a fund one, which is based on those three premises that we discussed before. And it was doing very well. So we had a quick early success. We have a number of exits, right? For example, Nexmo was sold to Vonage, etc. So we have lots of confidence. So what happened in 2016, in 2018, we quickly launched the fund 2. So as I mentioned, that was basically, we took a journey that going from a traditional CVC to more open platform. So in 2018, when we raised the fund 2, we invited other corporates as well as the financials to join our LP roster. So in addition to Deutsche Telekom, I'm happy to say we have corporates like Zeiss and SKT, our LPs, as well as the financial institutions, including Harvard Vest and Newberg Berman, and many others. So today, DTCP Fund 2 is a multi-LP setup with both corporate as financial investors. But having said that, we basically stick into the same formula, except we scale up quite a bit. Our Fund 2 is now the $350 million fund. We're roughly about halfway through now.
Okay. And, Jack, you were actually in my book on corporate venture capital, where we're talking about Qualcomm and the JV with, was it Novartis?
Yes.
And your journey into Deutsche Telekom. Talk a bit about, and you can put this within a context of DTCP or just at large, your experience at Qualcomm Ventures and other CVCs, but what do you, there's kind of a Shakespearean timeless question of strategic return versus financial return. And I think each corporate needs to balance that for themselves to fit their individual goals. But how do you balance strategic returns versus financial returns today? Now that do you disclose what percentage of your LP base Deutsche Telekom comprises, or maybe that's too sensitive?
It's still a large portion of it. So this is what we did, right? So I mentioned the Deutsche Telekom DTCP, that we have 3 parts of businesses. I talked about the VC and our progress we have made from Fund 1 to Fund 2. So we do have a small PE fund as well, primarily focused on infrastructure investing, fiber to home, cellular towers, focus in Europe. So my partners in Europe focus on that. So
and are you 100% controlling? Is that like M&A? I mean,
no. Traditional, it's actually a subscale PE fund, right? So what we typically do is we partner with other big, large PE funds like Blackstone's.
Okay, so you club up. Okay.
That's right. So typically in a PE style investment, where a syndicate will own majority of the operation.
Okay.
Yeah.
And infrastructure like fiber to the home is almost a utility. So it's giving these leverage people what they want, right? I mean, my experience with KKR and Blackstone and these guys is like they put in $1 billion, they club up a few, they get to 12 billion, they lever up 70-80%, and they buy Ireland or something, right? or Tele-Denmark, TDC.
Right. Yeah, so we do have a PE practice there as well. So as I said, my colleagues and my partners in Europe are focused on that, the infrastructure, as well as cloud computing. Like, as you know, one of the things, which is kind of sideways a little bit, just talk a little bit on the digital transformation. I think one of the issue that, cloud computing is utility, right? Think about, there's Verizon, AT&T, there's Deutsche Telekom, Telefonica. In Europe, one of the things Europe is missing is the equivalent of AWS or GCP, right? So today,
and it's even a legal issue. It's a legal issue for information to not be in the hands of a European domiciled server.
So we've been talking a lot on that subject, right? And I think we at DTCP, certainly with footprints both in Europe as well as in the US, that we are very much focused on to foster that ecosystem in Europe on the cloud computing. But let's go back to the topic we talk about, how do we balance the two, right? So now
strategic versus financial returns.
So now we sort of operate outside of the campus of the DT, for lack of words to say. So we are giving a little freedom to invest. So what we have to do is to balance is that DT still very much want to invest in business that's considered strategic, but sometimes a little bit high risk. But as you know, how we all started with 5Gs or AIs early on, you're taking a lot of risk, and corporate tend to are willing to take that risk because there's a strategic value to that. But it's really hard to balance the two. One side, the CTO office says, I want to do X, Y, Z, but the CFO says, I also has to be responsible for balance sheet. So what we have done, DTCP, which I thought it was pretty interesting. So broken into 2 parts, right? Aside the PE, we also have the last parts, the advisory services. So in there, what we do is that we are doing 2 things. One is, as a platform, we invest companies. One of the value add is developing corporate relationships, right? So DT, T-Mobile, obviously are very friendly to us. So whenever we make investment on the VC side, we do the other way around. So typically the CVC works is that you find a strategic fit, and then you try to make an investment. So sometimes you may not get the best breed because companies are willing to form a relationship with you, may or may not be the best breed, right? So that's debatable, certainly. So what we have done is we, first of all, set a target. We said we're gonna go after digital transformation. I think every company needs to go through a digital transformation. And our LPs, whether SKT or DT, is in a perfect position to be enabled, right? So we know that direction we are going to is strategically important to our LPs, because I'm not investing in candy shops, right? So digital transformation. So when that direction is set, what we have done is basically says, well, how do we pick the best breed of company that we think is going to generate meaningful financial returns? Right, so that's number one, the criteria. So how do we find these companies? And then once we make an investment decision or we make investment, we work really hard helping these companies to leverage the corporate relationship we have with DT, T-Mobile, SKT, etc. So that's what we have a separate operation advisory services. So sort of the BD, I think most of the venture firm from Sequoia to Benchmark will have the BD function, right? So that's what we call the advisory services. We have a team of dedicated people that continuously to helping portfolio companies navigate through the corporate sponsors that we have, as well as the partners we have outside our LPs, because we're continuing.
Right. And you see the Silicon Valley team of NTT Docomo is kind of heavier on this BD advisory than they are, on even cash deployment, and then some are, okay, that makes sense. I mean, Jack, we've had these conversations before where I think I'm originally a telecom entrepreneur and even grew up in a telecom family. If you've got Deutsche Telekom and SK, now SK is a huge conglomerate. Like they're in more things than just telecom than a lot of people would know, which is probably good for you. But if you look on the telecom side, I would argue that they should have been leveraging venture capital a lot more, and they were asleep at the wheel on a number of strategic things, like to allow Steve Case to build modem banks and have America Online and access the infrastructure of the incumbent telco and offer internet service, free serve. None of these things should have even happened. If you look back, the telcos all owned directory, they owned the yellow pages, and they had call centers, making a ton of money on people calling in rather than, from their car as opposed to directory services. That moved to Google and, Yahoo and Alta Vista search. They completely were asleep at the wheel when they lost a utility, annuity on revenue from advertising, yellow pages, directory services to that. And if you look at the ARPU being minutes, line rental, roaming, data, that I know there's a lot more to it, but I think Deutsche Telekom's got M1, M3, M3 of M1, M2, M3, how they sell into the small businesses, the medium businesses, and the global accounts. For you to be able to invest in so if I at 7BC Venture Capital invest in a startup, introduce them to DTCP, you invest, and then you get M1 or M2 in Germany selling that product, to your customers. And then after that, you go to Korea and SK is not just in Korea, they're dominators in all of Southeast Asia and around the world. So that's a powerful thing to unlock.
You said it, right? And the trick here is that we try to identify the best breed of company, right? So we identify the winners, not necessarily the people that, hey, I'm down to my last breath and please telco save me, that type of company.
Yeah.
Sometimes, the CVC get into that situation. What we try to do is find the best breed of company. Case in point, for example, we have invested in a company, SD1 company called Ariaka. It's probably pretty well known in the Valley. Providing SD1 services has essentially become essential services in the lockdown period, right? And what we did is we scanned the market. We find Ariaka is one of the best, and it continued to perform very well. And then after we make the investment, we didn't go to DTS for permission first. We say, hey, SD1 certainly an area that's going to go forward, because we know the traffic is changing from headquarters to remote offices. Traffic is flowing everywhere to the application. So you need something like SD-WAN to make it work. So we identified the company first, we made an investment. And then afterwards, basically, now we're starting to introduce Ariaka to DT, different entities in North America, all the way to Europe. And our partners in DT quickly realize and appreciate it. They go, hey, this is truly one of the best companies. And they're starting to a joint venture, joint resale agreement together. And today we know they have won multiple corporations and millions and millions of dollars that flow through the DT channel. And the DT's customer in Germany, as well as the rest of the world, enjoy their services, right? So, which is a good example for us that we we were able to be more autonomous and free thinking to find whatever the next trend instead of relying, a traditional tightly controlled CVC where the CTO wants to go, right? So
Yeah.
that's a good example. Another good example is probably, I'm very proud to be an investor at Fastly. As you know, the company is performing extremely well under the current circumstances. Again, a DT, back in the days, again, we would just basically go out, try to find what is the most innovative CDN out there, because Akamai has been in the market for 15, 20 years.
Yeah.
Akamai probably have resale agreement with all the telecoms in the world, right? So
Yeah, and a graveyard full of like raised 60 million and died companies.
Right.
It's a big graveyard area.
Yeah, but we were able to identify what the essence of Fastly, which is a developer first, like API driven, sort of a new trend of doing things. We really get comfortable as a company. Actually, we led a pre-IPO round for Fastly, and then I guess the rest of it, it's not quite history yet, but at least we certainly, from the market performance perspective, Fastly has been a darling for Wall Street for the last couple of weeks.
Well, let's talk for a minute about valuations in the late stage market. So, what is typical revenue for a tech company? I don't even want to say startup at the time that you guys typically make the first investment.
Yeah, when we devised that, I mentioned it back in 2016. During my first 8 years experience, I decided to bet on one thing and one thing only, which is enterprise software. And one of the reasons is that I like the recurring business model, right? So, so that you get comfortable and predictability. And obviously, it's not an empty land, even in 2016, right? Because things moving very quickly. So we realized that actually the best places for us to insert ourselves is what I call an expansion stage. So how do I define that? So the way I define that is probably, I would say probably loosely bucket into 4 stages of venture investment. Like first is angel and seed, right? So you take some money, and then you have the Series A, traditional Series A. And then you get into what I call expansion, and then so-called the growth and the pre-IPO. So how do we define that? So again, we focus on SaaS company. SaaS companies speak in ARRs, annualized recurring revenue, which is the benchmark or the valuations based on. So typically when you and I starting a company, obviously there's no ARR to speak about, not even MRR to speak about monthly, right? So you get seed and angel. So once you get typically what we see in the Silicon Valley is once you get the first million or close to $1 million, that's when you're gonna raise, you have a product market fit, and then typically you get a Series A investors. Pretty much all top firms that invest in enterprise software these days, right? From the Sequoias to Andreessen and Horowitz. So that's extremely competitive space. And then once if you reach the $30-50 million, you have lots of traditional gross capital come in, right? So folks are doing very well there, and sometimes even the hedge funds are coming early. So what we find out when we started our fund in 2016, it's the most challenging is the expansion stage. Now you got 5 million, you got 10 million. So you have done something, and obviously you want to step up from the pricing perspective, from the valuation perspective, right? So how do you price that with a limited information?
Jack, you're talking about companies with 5 to 10 million ARR.
Correct. Yeah. So what we have, the DTCP has been pretty much focused on a sweet spot, what I call $5 to $30 million ARR. So hence I call the expansion stage, right? So again, you have the seed, early stage, Series A type of. So what we see is typically you look at the alpha beta order that we typically Series B, Series C, sometimes Series D for us, right? And afterwards you have gross capital when you raise 40, 50. And then pre-IPO. So that's been our focus. So that's, and again, from a vintage perspective, we typically, the company, by the time you get to 10 to $20 million AR, or the time to get to us is probably 3 years and 4 years into the company. So we have a kind of like a prospect, attributes look like the company, right? Typically,
sure,
people that I'm talking to that have a serious conversation. I'm always talking to people, right? Because I'm enjoying having conversation with all stages of company. But typically when we have a serious consideration for investment, typically companies 3-4 years old, probably over 100 people, probably 5 to 10 million AR. And with that, also another thing that we've been focused on is, as I said, the subscription business model, right? So most of the companies, probably 90% of their revenue derived from ARR, right? So obviously sometimes they have professional services.
Mm-hmm.
And we tend to like the companies that are focused on what I call the mid-market or enterprise space. By definition, roughly about $75,000 to $100,000 first year for the subscription contract. The reason for that is, again, it's very tricky to price or to evaluate the company at the expansion stage. So a little trick I want to share is that if you the ACV is $100,000, right, and annual contract value.
Average, yeah, okay, yeah.
And if you have a $10 million ARR, I know that's alphabet. So mathematically, you go, oh, that's great. This company has 100 customers, right?
But you also got to make sure you understand the unit economics. Like, what's the cost of a sales cycle
That's right.
to get to a 75? In my ancient days, we had
that's very
$1 million contracts.
Yeah, so that's very interesting. So the two things, right? I'm glad we talked about little details here. Hopefully, some people enjoy the minutiae here. So number one, as I said, we like to pick the obvious winners, right? So the company, you should get to $5 to $10 million AR in 3 years and 4 years, not 10, 15, right? Extreme cases. So you know where I'm going. Number two is, how do we get there? So can we get to your first 5 or $10 million AR with 10 million, 20 million, not 50, 70, right? So those are all the benchmark we're using, very carefully crafted. So the way I kind of want to talk about my favorite subject, which is sports, using analogy. So because we are a growth capital stage venture firm, right? So what we typically, I would say my job is compared to an MBA college scout. So what that means is that I'm going to a campus and I'm looking at a bunch of student athletes. I'm looking at one that looks like a future NBA player, right? He's 19 years old. He's probably 6'3", 6'4", and still have an inch or two to grow, right? And probably weighs like, I don't know, 180, 200 pounds. It's a perfect athlete. So I'm looking for that type of company. Now, again, every firm has different philosophy. At DTCP, we are obviously looking for the possible obvious winners. Right? So we identify companies that clean cut has that. Versus if you're an MBA scout, the chances are that you walk into a gym and you see a kid who's like me, 5'7" and 150 pounds, 19 years old. The chances that kid's gonna make it to the NBA is pretty lean, right? So in other words, when you evaluate a company, you can use the same way to do that because it's well understood how company grow from one stage to another, right? Again, taking my favorite company, Fastly. If you look at a Fastly today, roughly over $300 million in revenue run rate, which is equivalent to AR. And all it takes, the company was started in 2011. So 9 years from zero to 300. So that's not exactly the LeBron James, but it's certainly NBA All-Stars in lack of a comparison, right? And
Go ahead.
So we see these company, fascinating company in the last 10 years, you have never heard of, from zero to hundreds and hundreds of $1 million AR, whether it be Zoom, whether it be Datadog, whether it be, so many companies that we can go through, right?
Right. Well, it makes sense. I mean, it sounds like you're bridging people into the major leagues and you're not looking for companies that have been pivoting for 18 years to get to 500K MRR, 6 million annual. Look, so we don't need to spend a lot of time, but I want to cover, because you know this market better than anybody, what's happening with valuations in the current, if we're in a W curve beginning to maybe come up and going to go down again. But where are you seeing a shift in valuations for the growth stage companies? So a company's got 5 to 10 million ARR, annual recurring revenue run rate, and then you guys put a big check into it, and it's now you're bridging them to the major leagues.
Yeah.
Where have those valuations been trending at pre-COVID, during COVID, and what do you think we can expect? And compare that to the public markets.
Yeah, that's a very good question. That's something that we're dealing with every day. So again, I'm going to share a little tips here. So for entrepreneurs and as well as my fellow investors, and I've been very focused on that metrics because, as you said, during the tough time, especially the tough time, the business has to make sense, right? So So one of the yardstick we're using is so-called the capital efficiency. Everybody has a different definition. Our definition is we look at the trailing 12 months. How much you spend from cash burn towards how many net new AR you have generated. So, again, I'm getting to a little technical here. Is if you look at a SaaS company, the EBITDA, it's not that meaningful because you have a cash advance payment. So cash burn is the most important thing to running a SaaS company, right? So the very important that you have a good capital efficiency definition by the AR you have added in the last 12 months divided by the cash burn you have. So you want to see that ratio close to 1 as possible.
And Jack, I jump in there and say we get even, I think everybody does. You got to get granular when you're looking at an investment to say, what is an enterprise SaaS company is where you're focused. What is the CAC to LTV? What's this is becoming acronym soup here, but what's the cost of acquiring a customer? Yeah. And do you have to send an MBA on an airplane or a man in a van to get the customer? You've got to go to Omaha, or is this telesales? So what is the cost? And for some online businesses, what do they spend on an ad to get a user to transact? Yeah. And then how quickly do you recoup your CAC, your cost of acquiring? Or is it a lifetime value where they're promising the VC, you'll get paid in heaven, I need your money now because
so if you don't
I
have
spend 100 to make 200 or I spend 100 million to make 50 million revenue. That's
exactly. So as I said, if you want to have a quick conversation with somebody, ask for advice. Somebody asked me advice for 30 seconds. I'll ask the entrepreneur, I say, how many net new ARs you had in the last 12 months and how much cash burn you have? If your ratio is close to 1, that's good. If your ratio is 0.5, then that's not good. That means you spend $1 burn, get less than 50 cents on the AR. That's not very good. So let's talk about valuation, for example, right? We all know the valuation probably went a little bit, how do I say, a little bit crazy in the last, before the lockdown, right? So what happened is, I think a couple of reasons. Number one is, there's so many success stories I mentioned earlier, whether it's Datadog or Atlassian. All this company becomes a mega billion-dollar company listed in public, right? So the public multiples actually are very, very high. And if you look at it today, even today, the trading multiples for the top grade companies, Okta's, and they all trading hovering around 15 to 20 times the current year revenue multiples. Think about it. Some of those companies not even profitable, right? And traded that kind of multiple. So what happened is it creates a pressure back in the private market. Entrepreneurs want to have that multi valuation as well. Now think about a minute. Again, using the MBA analogy, not perfect. Now think about it. How many tech IPO, especially enterprise SaaS IPO, there is for the last couple of years? Last year, I believe it was 26, and the year before is probably similar to 30-ish. So think about it, how many SaaS companies that we know, right? So again, those people who made it to the IPO, company like Fastly, they're going from 0 to 300 in 9 years, are truly one of the kind, right? These are the MBA superstars, and they deserve that kind of multiples, right? Because you have performed, you have to demonstrate. Now, for the people who are still 3 years into that, you got the first $5 million, they want that kind of valuation, that kind of rich paycheck. It's a little bit outlandish, right? I mean, obviously there are companies that are willing to pay that, and the companies demonstrate they deserve that. But I would say mass majority of that should not think about that's your yardstick, right? Because you should not get 20 times because you are not proving you're all-star yet. So what happened during this period of time, last couple of months, I have to say, it's very intense for us. So now we see a bifurcation. So the company has demonstrated that continue to perform all the key metrics that the investor like, continue to command that kind of revenue, continue to multiples, because we know the world is moving towards that digital transformation. So the companies that are doing well in that sector will continue doing well, if not accelerating. For those ones, a questionable business model doesn't necessarily have the efficiencies we're talking about. I really have a hard time raise capital. So, investors are run for the hills. And also it's interesting to see that, one of the reasons driving the valuation, not because the public multiples, but there's so much capital has raised in the last couple of years, and continued capital to pull into that. So as a result, everybody is driving up the valuation. But today it's interesting because I think the growth capital or the funds has raised lots of capital, continue to be very diligent, very careful in picking companies. And for those, it doesn't have a solid balance sheet on the VC themselves, quickly, retreat. So as a result, I think the valuation, I wouldn't say normalized, but at least more rational today. And the deals are still done very quickly, by the way.
Sure. I mean, so what I'm hearing is there's a focus, we have more austerity in startup spending in the current environment, right? Where people are taking pay cuts or getting rid of the Michelin star lunch, types, extravagant spending. But on capital efficiency, clearly it makes sense in any market to understand, does this company spend $50 million to make 20 million in revenue? Yep. Or are they spending 50 to make 40, but they will have economies of scale and tip into profitability based on some assumptions,
yep.
Right? Do you when you're in the public market, yep. and there's a belief that the company will survive even worst case 2-year recession, okay, that you're discounting cash flows from year 3, 4, 5 and beyond, right? So you're looking at what is the top line, bottom line margin in the G for growth to DCF that, and what are comparables. So they're not, if you believe it's going to make it through. Now, if it's further off in the year, the discount is further, So whereas VCs are more backing their way into a valuation of, can I get a 4x return on this if it's late? Can I get a 10x return on this if it's early, right? So how do you compare valuations right now shifting because of Corona in the public market versus the private market? And I would think anyone's plans for IPOing are probably on hold, right? I mean, what do you see there?
And also the other thing,
unless you're Zoom or a Supernet beneficiary of lockdown.
Yeah, exactly. So I'm no investor in biotech or healthcare anymore, at least to say, right? So what I know, let's stay focused on what I know, enterprise software, right? So if you look at as you say, even before the lockdown, the yardstick has changed. So traditionally, if you asked me 2-3 years ago, hey, when the company go public, the most investor will tell you, if you reach the $100 million AR, roughly trading revenue of $100 million, you can consider it go public, right? But today that has changed. Just to give you stats, probably not a perfect number, but last year the 26 SaaS company went public. The average, or the median, I should say, the revenue run rate is about 270 million. So again, the bar is much higher because that takes you another year or another year and a half, right? Because at the IPO velocity, company probably today growing 40-50%. So instead of 100 million, now you got to go queued up to 200, 250. And I think the bar will continue to raise because, as you know, the window is shut. And even the window open, the number of companies can go IPO are so few, right? So I'm talking about 30, 40 companies a year. We know every year the hundreds and thousands of companies. So realistically, the company going public is very, very low. So which means that, lots of exits probably going to through mergers, acquisitions, right? And that if you statistically, we read all those news, but how many companies actually acquired for billions or multi-billions, because it quickly whittled down very quickly, right? And one of the other challenges that I think the investors are facing is that SaaS companies are traded at very high multiples. But most of the company is not SaaS company. GM is not a SaaS company, right? GE is not a SaaS company.
Yeah, they sell one-off products and they're trying to diversify their ARPU like a telco.
That's right. So how do you buy a company that kind of multiple? So that creates a challenge. So there are certainly lots of these asymmetrical things happening in the VC land. But what people liked is that the subscription and digital transformation. I think all the things are going to the right direction. I think. The valuation aside, one thing what we're hoping to see is that digital transformation continue to accelerate, to improve the productivities. And also, I think the most important, that human need to be connected, right? So Zoom has been, but albeit all the controversials, let's just say video conferencing, for example, it's a really nice tool that you and I can have a pseudo face-to-face. And I hope other people can see us in sort of like the virtual person as well. So that's been a really help. And this is not possible 5, 10 years ago. When I think about video conferencing, you talk about room for a $10,000 equipment investment before you can do anything.
Okay. Well, by the way, I've got a company to pitch you called Privis, which we'll do offline, but they basically have a product that's like WhatsApp and a product that's like Zoom. But these guys were in the cyber security unit of a military, and they were wiretapping with deep packet inspection, DPI. They can get into any signal call, any Zoom call, password, no password. They can get into anything. And so people are using encrypted communications for either voice or sending God knows what kind of pictures to each other, or doing a big deal on a Zoom, and they can get hacked. Also, you can be geo-fenced in China or UAE. These guys promise no hacking and no geofencing. And I've said to them, we should methodically take them out to telcos. We could put an appliance in their walled garden and offer it as a branded service with their own servers. But that for another time. So Jack,
to wrap it up now. It's 43 minutes, yes.
Yeah, last thing I want to talk about, and we can be brief because we're taking a lot of time, is there's a bank in Europe that is an investor in our fund that we're advising that has a CVC, and they're trying to formalize how information is shared with the CVC unit, with the M&A Corp Dev unit, but also I'm telling them that they should formalize with HR, R&D, IT, and even strategy. With all of your years in CVC, did you emerge with a model of how to separate corp dev from M&A, or when R&D is trying to get the CVC to invest and you say, no, you do that in R&D, that's not a business that's going to go like Fastly. Any parting thoughts on this?
I think it's very important to firewall the information, right? Because CVC or VCs, the company disclose information for financial investment only. So these informations are entrusted you under NDA. So you have to be very careful what under the NDA can share, cannot share. So what we typically do in this situation, obviously everybody, our partners, whether it's HR and CTO's office, always coming to us for advice. So what we typically do is, be very sensitive to the information, make sure that what we can share. In most cases, we just try to bridge the gap, right? So, hey, maybe this is what you're interested in. Then we say, okay, then you should talk to the company directly. We can't just share the information without a permission. What we try to do is expedite that information flow so they can have a direct conversation. The other thing that I think that the CVC can do very well is competitive information, right? Because, anybody in the CVC or VC talk to us companies. So whenever the CTO comes with an idea, the next 5G idea, we can always say, oh, by the way, have you looked at X, Y, Z, and so on and so forth. And I think that's probably the most valuable advice that we can give it to the companies. One is, the complete picture. And secondly, we cut the chase, cut the noise, and guide them to the right channel so they can have much expedited the conversation to drive their conclusions.
Well, Jack, this is great. Thank you so much for your time and insight and wisdom. I look forward to maybe walks on the beach in Half Moon Bay before things are totally normal out here, and talk to you soon.
Thank you so much.